All right, welcome everybody. Welcome. This is another episode of Sang Lucci TV. We have here a special guest, Tim Biggan. Finally, we got our tech
Finally
situation.
is right.
We've been having problems with this for a while now. What's going on, Tim? How are you, man?
We're about ready to freeze our you-know-what off here in Chicago come tonight. Record lows, but certainly record highs in the market. I think SPOO's closed virtually unchanged.
Yep.
So interesting markets to say the least here lately.
Very interesting indeed. Very interesting indeed. So listen, I mean, there was a lot that that we started talking about before on our episode before the gods cursed us here and we had to shut everything down. So let's get back into it here. I know you've been an options market maker, but there's a lot of other things. Sort of, you've been in the space in the options world. You've been writing too about the option stuff. You've kind of done the whole spectrum here. So give everybody a nice intro, brief intro on where you've been and what you're working on now.
Absolutely. I started as a runner in 1985, started trading on the floor of the Chicago Board Options Exchange 1987, right before the crash, which was absolutely invaluable experience from a risk control standpoint. If you could come in the day after the crash and trade, if you weren't blown out by your risk manager, yeah, that was the greatest day of trading in the history, I think, of trading. I mean, because the
give
one
us
guy.
A story, dude. Give us a story from there. Give us a story.
Well, I mean, the risk managers, when they come down, I mean, the markets back then, there's no electronic trading really. You didn't even know that following morning where you actually got all your trades done at. You got done, you're waiting on prices. But
right,
if you took care of your risk on that previous day, that morning when the risk managers came down, they were just paying whatever price to get these guys out. I mean, some of the theoreticals that we look at when we used to walk down in the morning, we had our sheets, it was called, they were off the charts. You're just like, you couldn't help but make money, and like I said, it taught me taking care of your risk and being able to trade.
West. That's the wild, wild west right there,
yeah,
man.
Absolutely. That's what you saw. The days you saw on TV where guys were screaming, yelling, paper flying, everything, but, it really 90% of the time was complete boredom, 10% sheer panic, not much in between. So we had a lot of fun back then, different world, completely different world now. Now we're all upstairs. And okay, electronic trading.
Right. So then you moved into, and then you moved into what?
Yeah, then went upstairs, started managing some higher net worth clients with option overlays, doing some, covered calls, some hedging and so forth. Then looked, and a lot of these guys had big stock accounts that we used the stock marginability to do some volatility arbitrage on top of it. So, say a guy had a 10 million account, he would give me 10% of that to use for Volar. So I'd trade $1 million in Volar, try to make 15% in a non-correlated fashion. Overall, we'd add, 150 basis points to the overall return without really disturbing things.
Not to stop you right there, but explain to those who are unfamiliar with Volar or have no idea what does that mean. Can you give us an example of Volar and an example trade or whatever?
Yeah, absolutely. I mean, it's basically when it's usually, comes from what I trade is a lot of relative value spreads. So we're using the option scanners over here at RB to identify large order flow that will either, if they're buyers, will artificially jump the price of the option compared to the others around it, or if they're sellers, comparatively push it down. So if buyers come in, a lot of times we will be sellers of that option, hedge off with fairly valued stuff. We're selling slightly expensive, wait for everything to realign, take the trade off for a little bit and move on. Kind of a market maker approach, but we can cherry pick.
Yeah, it definitely is. I want to get into that a little bit later, and this is one of the coolest things about you that I definitely want to delve into. All right, so you went and we're doing some managing money for high net worth client, and then what? And then you went over to start market making?
No, basically, I started a little Volar fund that we never got traction going. With the cost of everything, you really need to probably get to 9 figures as far as assets to make sense in the long haul. The problem is until you get to about 15 million, no one's really going to look at you. So it's a tough go. Once you get to a certain point, guys can start to allocate simply because they have to put a minimum amount out, but they
Right.
can't be more than a maximum amount of your overall fund. Is kind of a catch-22. So
Indeed.
the fund did fine. We basically closed the fund down, went into separately managed accounts where we didn't have that sort of scenario, and
Right.
still do that to this day. And now upstairs we're trading our own accounts up here, trading for others, and really using the scanners to identify kind of option flow out there, kind of in a market maker sense.
Very cool. All right, so we're going to talk about the scanner, guys. Everybody out there, we're going to talk about the scanner latter portion of the episode. Anybody who has questions here for Tim, specifically on the market making side or on the flow desk, whatever it is, throw it out in the chat thing, and I'll see if I can get it to him. So I wanted to talk to you specifically about market making. What years were you a options market maker? Was that recently here, or was that a while ago?
Officially as a market maker, 1987 to 1990.
Okay.
At the end of 1990, kind of the world changed after the crash of '87. The little guys, you had to go join a group. It's kind of what we see now, consolidation. So the big become bigger. So I simply moved upstairs, basically as a market maker, but not officially. Same kind of trading style, but not in a market maker official capacity.
So, okay, so can you talk to everybody about sort of the adaptation or sort of the evolution of what you've seen on the market making side from, the 90s after 2007 when Regulation NMS came out and everything became automated. So I kind of wanted to know your knowledge as far as what's going on now, as far as the automation side of things. How are market makers now automating everything, and then what are they using here, to better, I guess, better make their spreads when they tighten, when they widen them. Why do they do this thing? How do they account for all the customer order flow that's coming in? And are they also paying for order flow too to build inventory and things like that? So what do you notice that's changed? I guess let's start there. And then let's see if we can pick a couple things in between. So what do you notice? Give us sort of the evolution of options markets after things became automated.
Yeah, absolutely. I mean, there is, no need for really that central exchange with electronic trading. I mean, everything is kind of funneled into, a bucket, if you will, but you don't need to be on a trading floor in a place. You just need to be, if you will, in some way hooked up to that stream of exchange. So that is the biggest difference. You're seeing, the big boys, the Citadels and so forth of the world, who basically have, if you will, taken over kind of the, market maker sort of standpoint from the exchanges. It's kind of funny. I do a little TV spot once a week down on the exchange, and a lot of the firms now are down on the exchange floor. So the trading floor has basically become, almost an office for them, because it's sad to see, but outside of the VIX pit and the S&P pit, there's really nothing left from the old trading floor down there. So you don't need a central marketplace. You don't need runners like I was running the order outright. Everything, is electronic, so you can be anywhere at any time making markets. And, if you've seen, the big boys, how they make markets and the sophistication, pretty slick stuff. And,
so that's what I wanted to get into. What do you know about the sophistication of it? What do you know about sort of the behavioral standpoint of how they make markets now? I feel like it is so unbelievable sometimes, the way that they adjust their spreads and the timing that they do. And then also the way that they go ahead and start taking in liquidity, the prices that they do that at and the prices that they offload at. I think it's genius. I'm sitting there watching some of these options, and I'm like, dude, these guys know far ahead of time where retail money is coming in, who's buying, what they're buying for, what are they in spreads, all that kind of stuff. How is the sophistication now? Can you talk to us a little bit about the specifics on how sophisticated these guys are now?
Yeah, absolutely. And it's, very akin to when we were on the trading floor to start with. We all had our very, little book, and we all had, our little piece that we knew what was going on in the world. Because of automation, they can be everywhere all the time, and basically automation has allowed them to have, 5,000 market makers simultaneously with that brain working. I think that's the best analogy to use. So in the old days, as a market maker, I had my little niche, right? And that was very good. Outside of that, right, I didn't have that information. They're able to build all these algos, everything they have, which basically allows them to capture everything out there that has an edge, hedge it off immediately. And
Right.
it's very akin to the casino in Vegas. You keep doing that over the long haul, you
Right.
will make money, and lots of it.
Wow, man. Okay. So that's kind of what I wanted to get out of you here. And then finally on this market making thing, before we get into some of the option scanning things that you're up to right now, how do they adjust? I know some of these market makers. I'll look at the volume that they're bidding and offering, and I'll notice obviously it's in the hundreds. And you look at the volume that's traded, it's like maybe 5 contracts. You know what I mean? So
Right.
they're offering all this liquidity. And for only maybe 20 contracts that get traded, all of a sudden some guy like me comes along and plows through their spread and gets maybe 500 contracts. What do they do now to adjust? Number one, like what do they do now to hedge that off? And then number two, what do they do about shaking me out of the position? You know what I mean?
Right.
Are there games like that are being played? Can you talk a little bit about the game theory? So first, what do they do to hedge it off? And then talk to us about game theory here.
Yeah, absolutely. As far as hedging, usually they go right to the underlying.
Okay.
So if you're in there and you have to, if you're buying an option, we'll make it on the buy side. I think it's easier to understand. They are sellers of the option.
Right.
Let's say you're buying calls, right? They're selling calls, so then they have to go buy a certain amount of stock to hedge that position off. So obviously they can, do something simplistically delta neutral. Right. Obviously they look at what correlation does this have to other stuff in their option book. They may have an offset immediately by someone who's selling calls to them in a different highly correlated name. They may, hey, this is a perfect, we'll take it. So they're just capturing everything they can, hedging it out according to their specific model, but simplistically they want to keep as neutral as possible, kind of like a bookie, right?
Right.
You don't want to, if you're making odds on the Super Bowl, ideally you want 50% on each side, and you just capture the vig. That's what they're doing here. But as far as in this environment, where many times the option market's too big for what they can hedge sufficiently, and a guy comes in and does the steamroll on them, right?
Right.
It can be a world of hurt, and many times they get trapped, on the other side. I think it's a great time from a retail side, to be in the options market. It's really the last thing, that you can really, you have the advantage over. You can trade. They have to make markets. They're putting stuff up on everything. You can or cannot trade it. If you like it, right, you can run it, and many times you can trap them. You talked about, what do they do to shake you out?
Yes. Yes.
We saw it today kind of in Zillow in that, with the merger ARB, all of a sudden the shorts on Zillow, once the deal closed, got squeezed, and you saw Zillow just fly, right?
Why?
Same thing here. At a certain point, it's kind of a cry uncle game, right?
Right.
It's kind of like, Ackman versus Icon, right, on, certain battles. Who's going to break first? So don't think, if you're trading, a couple thousand contracts, many times you can make these guys squeal as much as you. Otherwise, a lot of times you see big retail paper come in. They'll let the market, they'll identify that. They'll let the market go up. And then once they see that flow start to wane, then they start to bring it back down. They've trapped these guys up here. All of a sudden, these guys are bailing out. And that's kind of the game they can play. But, big versus big, it's a swinging contest.
I think one of the things that you're alluding to is that the one thing that they have going for them is time, essentially, right? So they can kind of wait for this thing to work itself out, and then wait for that volatility to come off, and then start working that price down, and I guess sucking these last bits of retail that are kind of hopping in. Still trying to look for a move, I'm assuming here.
Yeah, absolutely. They have deep pockets too.
Right.
So they can take a lot more pain
Right.
than the average retail guy can, right?
Absolutely.
So, and especially with money where it's at now, they can just go to the Fed window, the Chicago Fed's right down the street. I mean, what do they borrow at? I don't even know if you have to pay anything anymore. Just give me a couple more billion, I'll buy some, And that's really what we're seeing. I think the reason the market's doing what it's doing, where we're going straight up.
Right.
what is the, how much can they borrow? It's virtually almost unlimited.
Unlimited, unlimited.
Yeah.
All right, all right, all right. So let's switch gears. Let's go back over to what you're working on now, as far as the scanner that you guys got over at Arbitrator. So talk to us a little bit about that. What does it look for? What's the logic behind it? Give us something on that.
Yeah, absolutely. It looks to identify basically, orders that are sitting out there, right? That for whatever reason the market makers are leaning on. It's called.
Okay.
So, this is an order, and it can be really of any size. Sometimes it's fairly large orders. Sometimes it's small.
And for everybody out there, can you explain that market maker lean? A lot of people don't really understand it. Especially a lot of newbie traders. So we get a lot of newbie traders out there. Can you explain the market maker lean there?
Yeah, absolutely. So say the market going in is $1.50 bid offered at 2.
Right.
And then someone comes in with an order to try to buy these options at $1.85.
Right.
Theoretically, simplistically, they're worth $1.75, right?
Right.
Someone should be selling these options, but because the market makers are the market makers and no one is out there hitting them, they will let that order rest out there.
Right.
And hope for basically the ability, if someone's buying calls, right, they have to sell those by the stock. If the stock drops further, they can get their hedge on cheaper and then hit it. So that's basically their orders out there, and they're betting that it's just them versus that order, and they're going to be able to kind of, if you will, play with the market a little bit, get a better fill on their hedges before they take the order. What the scanners look to do is identify that, and we'll jump in and give you, if you will, a fair value price than the market makers, simply because we're happy with obviously profitable edges out there, to say the least.
So you're going for, let's say, the situations that arise where somebody jumps in between a spread that's either over the theoretical value or whatever, and then that's your little edge right there. You're going to take that order and then just lean off of it right away? Is that what you guys are doing?
Yeah, I mean, a lot of ways to approach it. You can simply try to, if you will, take advantage of the order, scalp it right back, right? So you use that example. It's worth $1.75. You sell it at $1.85. Maybe then you try to work a 180 bid since that order's gone, right? Now these guys are saying, oh, I should have taken the 185. Well, I'll take 180. You're able to capture that nickel. Or we can do, in essence, what the market makers would do, sell that 185, go hedge it with stock and carry the position, do it with another option, do some, whatever spreads or maybe ratio spreads, calendars, verticals, whatever our optimal hedges are. So kind of running a market maker book if we like to do that.
Okay, so talk to us a little bit about, does it also pick up for big retail paper? So talk to us a little bit about, the big retail paper that you see out there. So let's say you find, 2 months out or 3 months out, all of a sudden you see this 10,000 block contract go off. Are you guys doing anything with that? Are you guys working orders beyond that? Are you guys watching or directing attention towards that particular option after that order comes off because of the increased volatility or whatever? So talk to us a little bit about that big paper that we see in the markets often.
Yeah, as far as identifying the flow, we're not able in this day and age to figure out where it came from. And we would obviously, to some extent prefer retail over professional, just because professional may have, some knowledge behind it. So if you're seeing, a lot of what we do have, trade count will a lot of times give you the idea. So if you see, 1,000 contracts trade, but it's all in 5 contract sizes, that tends to be more retail oriented. If it's 1,000 contracts in one print, that'll tend to be more professional. So that's probably the best way to do it. But at the end of the day, if they're paying the price, fairly indifferent to what it is. Obviously, retail many times will be even more price indifferent than professional. But it's hard to tell till even after the fact, whether it's retail, professional, or somewhere in between paper.
Okay. So let's pause here for a second. I got a couple more questions here for you. We got some questions here coming in the chat thing. We got John Loken here saying, does the fact there's no one physically in the pits change anything? Or does it mean that they're creating liquidity and doing their own thing from their computers instead of on the floor? I think we did answer that question. correct?
Yeah, absolutely. I mean, there really is, to a large extent, no need for a physical trading floor.
Right.
Board of Trade Merck just eliminated a lot of their last bastion of open outcry.
Right.
And, outside of the VIX and the S&Ps, really, there's nothing left on the SIBO floor.
All right, all right. So we got another question here from SR. It's an interesting one, conceptual one here. Are market makers market breakers? That's what he's asking.
Well, that's the old, the nice thing is, from our viewpoint here, we don't have to trade. As a market maker, you're making a market, and you have to make a two-sided market, right? Whatever it may be. So to say they're market breakers, you never have to take whatever they're doing out there, right? You always have the choice to avoid it. And, that's where I would highly, highly, look at, if people aren't familiar with, basic option pricing, reversal conversion market, it's a simple one. Get an idea what options should be worth, and that will, kind of get you out of that way. Also, obviously, implied volatility, in front of earnings and stuff, make sure you factor in that implied vol will almost always drop.
Right.
That's probably the biggest complaint I get from retail side. I bought these calls, the stock went up a little, and I'm down money. We had one guy years ago who was going to sue the exchange and everyone in the world, right? As well, you bought these, and you could have sold them. If you thought they were too high, you should have sold them. Then or sold puts, right? So there's many ways to take a bullish position, right? So be highly cognizant of kind of option theoreticals and also implied volatility, put call parity, stuff of that nature. Obviously, dividends and stuff factor in as well.
Okay, all right. So back to a couple more questions here, specifically on the scanner and the whole market making side of things. Do you feel that the market makers now of today, the sophistication of market makers now, which are doing everything through algorithms that are moving their spreads electronically, immediately, as soon as a customer, like I'll see so many situations where, it'll be, like you said, 150 bid, $2 offer, and I'll put a bid to 160, and then the market maker will join me. I'll put one to 170, the market maker will come join me, and then I'll just never get some of these orders filled. So I want to ask you, like, do you believe the sophistication has gotten that good that they're able to see all that order flow out there from retail, whoever it is, and there's a significant aspect of gaming that is happening more so than before? I want to get your comments on that.
Yeah, absolutely. I mean, it happened in the old days, the same way. If someone came in and, we called it carping the market, right, when in between the bid-ask spread, you can join them, and effectively you're leaning on the fact that they're there, right? If someone comes in, you can buy them knowing worst I can do is sell them back for a break even. If it happens to go my way, I can make a little money, right, as long as that order stays there. So it's always gone on. The difference is now with electronic trading, as soon as your order shows up, right, and by they, there is really no one, right? They just have built things that can, read this and instantly put it out there. So the gaming side of it, if you will, has gotten much more sophisticated, no question about it. If you want to call it gaming, market making, whatever you term it, but absolutely no question. Speed, rapidity of what's going on out there, is amazing. And I've seen stuff go on that, where when sometimes this stuff breaks down, the flash crash in 2011, right? It can get nasty for some firms whose, mechanics, if you will, don't stand the test of stress. So
I see. Okay. And then my last question there is, where do you now see the edge? I mean, you commented before about it's good to be retail now in the options market. I mean, where do you see the edge right now in the options market as a whole, in the equity options market as a whole? Where do you see the edge?
The edge absolutely, I think, comes down to, it really depends on what level of size you're at. The edge, if you will, for kind of the, 15, 20 lot trader out there, right, is, they can put their order out there and get priority. So again, I would, unless you're, aggressively trying to get into a position, a lot of times if you're trying to buy, hang on the bid, if you're trying to sell, hang on the offer, something trades, you can effectively, take that order first because you are public paper. So that's a big advantage. from where trading is now to where it was before. As always, you have the ability to trade when you want. Market makers have to make a market all the time.
Right.
That's another big advantage as well. And bid-ask spreads, have become super tight, razor thin on many of these.
A lot more tighter, yeah, man. You're usually getting penny cent spreads out here.
Absolutely.
Spreads, unless you're trading the illiquid names, most of them, a couple cents. That's it.
Yeah, and that's the huge advantage. I mean, back in the day when I was on the floor, right, we were quoting in fractions, right? So a 16th,
Right.
basically was, which was, a little more than 6 cents, was the tightest spread we would have, right?
Right.
Most of the time we were quoting an eighth, so it was a 12-cent wide spread, right? 1 1/8 to 1 1/4, right? Now it's 112 to 114. So that's a huge edge for the little guy. So a lot of benefits for the little guy, and again, patience, I think, is first and foremost. And when things start moving, remember what you're paying. A lot of these things that we see come in, that you see, this huge order flow move things.
Exactly.
People get trapped at, they're the, it's kind of musical chairs.
This is what usually happens in the retail world. This is what usually happens. You see some order flow come in. You see volatility spike up on an option, and then all of a sudden that order flow disappears, and your option premium goes to shit. Most retail gets stuck in that scenario. They always get stuck in that scenario, even though they know better, even though they know the situation, because there's emotions there, there's order flow that they're seeing. It's like, oh my God, we got to break out, or we got to break down. Boom, let's pay up for this option because we expect some follow through, and then bam, they just get absolutely destroyed. Do you believe that is a manipulated process? Do you believe like that's completely manipulated in the sense that they're trying to hype up these options so market makers can sit on the offer and sell them, and everybody that was sitting there buying it up or paying up for it just gets smoked? Do you believe there's any manipulation behind that?
Well, they see the retail order flow coming in, right? It's kind of like if all of a sudden the houses in your neighborhood start selling for more, you're obviously going to put your house on the market for a higher price than you would have, even though you think fair value may be lower. So it's absolutely not manipulation, right? This order flow is caused. And remember, as a trader, if you don't like that price, right, you can take a bullish stance, and this is what we're really doing a lot of, which is buy the underlying stock, sell that call. You still have a bullish stance. You're still leaning with the paper. When that order flow dries up, that call that you sold will come back down towards parity. Absolutely. You've captured that gain. So there's many ways to skin a cat, if you will. So is it manipulated? I think manipulation is the wrong word. Is it moving? Is it red hot? Absolutely.
Okay.
You know it's red hot? Yeah. And if you know it's red hot, whose fault is it for jumping into that fire?
Okay.
Anyone who wants to discuss, I'll be happy to, show another approach to that.
Yeah. You know what? I mean, honestly, this is such a great. I knew this was going to be a great interview here, so I'm definitely going to have you back, man, because there's so many scenarios in the options world that need a sort of a big picture look at it. You know what I mean? Because especially with all the algos that are out there now, with electronic market making, it's so difficult now to understand it and put words to it. You know what I mean? We see it happening every single day. We conceptually know what's going on, but there's nobody out there that is just saying, hey, listen, this is what's actually happening. You know what I mean? So let's cap this off here. We're already here at about 30 minutes. Guys, this is Tim Biggan out there for Arbitrator. So you have right now, you got your scanner. Where can everybody find you, man? Where can everybody find you? What you got going on? I know you write for the SIBO as well. So,
Yeah, you can just, simple way if you want me and just me is, go to Google, Tim Biggam, T-I-M-B-I-G-G-A-M, and a bunch of stuff will pop up. I do advise everyone an indictment is not a conviction on some of the stuff you may see out there, but just kidding on that. But no, I mean, there's a multitude. I'll be on Canadian TV tomorrow. I'll be on CBOE TV. I'll be on Traders Exclusive. So we have a little different hits out there. As far as if you want some more information, just generally on the scanners and what we're doing with them, and maybe a different approach, what we talked about, when things get red hot, what's a way to take a position but avoid, if you will, the frothiness. Just email Mark at marketing@rb-trader.com, and Mark can steer you in the right direction there, whether you want a trial on the scanners, whether you want maybe a consultation from myself on them how to use them, and we're starting maybe down the road to put together some trade ideas based on the scanners that are kind of retail oriented, rather than just highly speculative.
Okay, dude, that's great. So everybody, check back on the Twitter here for new spots here with Tim. Tim, thank you very much for joining us. I give everybody the links here. Incredible interview, man, and I will definitely be hitting you up in the future for some other spots, man. Dude, be safe out there in Chicago, man. We got like 7.5, 8 feet out here in Boston.
We're just freezing cold, so between the both of us, we're both kind of screwed, I think. So.
Yeah, so the mayor came out and told people to stop jumping out of their windows into the snow. Like, I jumped off my roof 20 feet just right into the snow. Dude, it was hilarious.
Absolutely how cool hilarious. Is that? You got to do that. When else will you get that chance? I may fly out to Boston just to do that with you.
Exactly,
We'll do the GoPro show jumping off your roof.
All right, hey, listen, we're out there in Chicago all the time, too, man, so next time I come out there, man, I got to check you out, man.
Absolutely. Right? Appreciate saying, and anytime anyone wants to talk options, love to do it. Options are my passion, so appreciate being on. Appreciate the opportunity.
Awesome, Tim. Take care, man.
You too. Thanks, Sang. Bye-bye.